Now, the Ministry of Finance is warning bondholders against limited tradability of their bonds at the end of a successful domestic debt exchange program should they choose not to sign on to the new terms, given as part of a one-week extension. This is coming at a time government is racing against time to secure a debt exchange program from its creditors in order to get a board-level agreement from the International Monetary Fund. Individual bondholders in particular have over the past weeks been holding their ground against signing on to the current debt restructuring program. The ministry is hopeful this new arrangement will get them to change their stance. This becomes the fourth time the deadline has been extended. Let's share with you details of the revised offer from the Ministry of Finance to potential signees. Now, the government of Ghana has made significant progress with all stakeholders, including financial sector industry associations and representative groups of individual bondholders with respect to the participation in the Domestic Debt Exchange Program, DDEP. The government hereby announces the following update. That based on the agreement reached with the Ghana Association of Banks, Ghana Insurance Association, and the Ghana Securities Industry Association, the new terms of the exchange have been accepted. A revised and final exchange memorandum will be released by Thursday, 2nd February 2023. The statement goes on to state that based on the engagement with the representative groups of individual bondholders, the following has been offered and will form part of the new exchange memorandum. That an affirmation that will all individual bondholders are free not to participate. B, however, upon a successful DDEP, there will be very few of the old bond in circulation and likely limit its tradability. In this regard, the government is pleased to make available to the following alternative offers to encourage all individual bondholders to participate in the exchange. It says, and these are the terms that government is giving, that all individual bondholders who are below the age of 59 years will be offered instrument with a maximum maturity of 5 years instead of 12 years and a 10% coupon rate. 2, all retirees, including those retiring in 2023, will be offered instrument with a maximum maturity of 5 years instead of 12 years and a 15% coupon rate. Additionally, discussions are being finalized with the Organized Labor and Pension Fund trustees on a separate arrangement in accordance with the Memorandum of Understanding signed with Organized Labor on 22nd December 2022 and in line with government's debt management program. Now, the statement continues to say that, that with this, government encourages all stakeholders to participate in the DDEP, an essential step towards meeting our debt sustainability and restoring macroeconomic stability and economic growth. These developments have necessitated a final extension of the deadline from January 31, 2023 to Tuesday, February 7, 2023, and a new settlement date of Tuesday, February 14, 2023 that will be confirmed through the new exchange memorandum. Now, the government appreciates the cordial engagement with the various stakeholders since the beginning of the DDEP that has made such remarkable progress possible. And it ends by saying that all bondholders are hereby encouraged to commence all administrative processes towards their participation in the exchange in line with the agreement reached. Well, since the announcement, many of the affected stakeholders have been reacting to the new development. Senyor Hosi is a convener of the Individual Bondholders Forum, and he's been speaking on PM Express.
There's no opt-out. Because now somebody's not bringing you an offer. He wants you to rather opt in. So by default, you're already out. I want you to please take this instead of what I already gave you. If it works for you, please come. I need help. It's an opt-in, it's not an opt-out. Opt-out, it means you're already in and you're now finding a way to get out. The whole thing about the word exempt, I don't even know who brought this whole thing together. It was because you see in the memorandum, we're talking about the eligible parties to this particular, to the memorandum. So it was listing the people who are eligible. So if you said you're eligible, it means that you are somebody they can talk to if it works for you. I think that we couldn't have had a better statement than one we had today. And in case people have forgotten, let's read this thing very, very well. It says that, which part is it? It says that we are free. Clearly, it says that you are free to...
That's point 3A.
Point 3.
Should I read it?
Yeah, please. An affirmation that all individual bond holders are free to participate.
And let's make a note. This is the first time in any official communication
that he has said that are
that.
free not to participate. Let me correct it. He didn't talk about banks. He didn't talk about insurance.
He didn't talk about even the Securities Association.
He didn't talk about anybody.
Yeah.
It's only individual bondholders. So I don't know what the perturbation, the threat whatsoever. I don't think you would have found anything better than this. So the minister has given you clear commitment that he has a contract with you. He's going to honor the contract. He made an offer for you to come into a new contract if it works for you. If you don't, no problem. I will still pay. He has given you, if you want to use the exempt for your word, for you to be happy in life, then the minister is just telling you that you can self-exempt. That is what you have been granted. And he has reaffirmed it. So I don't know what the perturbation is.
Dr. Edu Ananientwi is the immediate past Director General of the Securities and Exchange Commission and is the convener for the Pensioner Bondholders Forum. He's also been speaking on PM Express.
As a market person, I know the difference between I have accepted you and somebody say I'm opting out of the exchange. Because if you say I have exempted you, it's like you are a different package. I'm going to do everything that I'm doing with you under the old bond. I have not told you I may not be able to service the coupon and the principal. That's the meaning. Once you are out, that's whatever government is saying doesn't concern you because yours is not part. The people who are part are the bonds that government is saying I may not be able to handle this. And that is why I'm exchanging it for a new one. So if you are exempted, you are out of that pool. The rest in that pool, government has said, I may not be able, it's likely I may not be able to handle the coupon and the principal. That is why I'm restructuring it. So that's the big difference between exempted and you not opting for the bonds, the bonds exchange. It's just reassuring you, fine, but that doesn't, the whole thing is that if it gets to the term of payment and the person has even said, I will pay, and it gets there, so as a result of some challenges that I'm facing, some cash flow problems that I'm facing, I will not be able to do that. You don't say because he promised I'll pay, he will by all means make money available to pay. So that is a challenge.
Now let's broaden this discussion a bit and bring in Professor William Pepper of the Andrews University, Michigan, USA. Now, Prof, grateful that you could join us here. What does this new dimension mean to bondholders?
Good morning, and thank you for calling me. If we gone back to the position of the individual bondholders, they wanted an entirely exemption from this program. But you could also hear from the sentiment of the people who spoke during that period was that they wanted some form of income or regular income coming from their investment. So people wanted a coupon payment. Remember that government first option was to pay a zero coupon rate Government came to a 5% coupon rate in 2023, and this particular discussion after negotiation with these parties, government is trying to give them constant income at a rate of between 10% for those below the ages of 59 years and 15% for those also above 59 years. We also notice that government is saying that instead of having a 12-year period or duration, the new bonds will have a duration of 5 years, which means that there's almost a 7-year difference in terms of when your bond will be paid. One caveat from the new communication by government is that if you decide to hold your bonds, your old bonds, government has not mentioned that he's not going to pay. What it means is that you may have to hold your bond till maturity. We shouldn't forget that some of the bonds, the old bonds, they have longer years, more than the 5 years being discussed now. It's going to affect what we call the yield on the old bonds. If a bond is not having tradability or is not easily to be exchanged on the CSD, let me make it more simpler. If you cannot trade your bond in between time, the value of the bond will decrease. Okay. That is what government is saying in the communication, and is advising that there will be more trading on the bonds of the new bonds under 5 years. So he will encourage investors to buy into the new bond. And when the bond is traded often on an exchange, the yield or the interest on the bond goes up. And in that case, any investor who buys in that one will get what we term as total returns because the yield has gone up. But let me make it more simpler. If a bond is tradable, the interest or the coupon payment on the bond increases. So that is the future government is using now to entice individual bondholders and pensioners to buy into it. Simply put, within the 5 years, if you buy into the new bonds that government is offering, you can sell it on the CSD or you can sell it in the open market. Okay. And get returns and get out. You will not have to wait for the 5 years.
But when you wait till 5 years, it's possible that you run at a loss because the value would have reduced, right?
Yes.
Okay.
Yes, please.
Interesting.
So that is the futures that government is trying to use to probably put it entice, because now it says it's optional, entice individual and retirees to still hold on, accept their offer.
Okay. Prof, I'm grateful that you could join us here for your thought on that particular development. Now,